Welcome back everybody to Learn Financial Literacy. So in today's video, we'll be taking a look at the topic of credits and credit scores. So what is a credit, you may ask? Credit is the ability of a consumer to obtain goods or services before payment, based on the trust that the payment will be made in the future. So people, for example, they may require a car for transportation. However, cars are very expensive, so they don't have the amount of money needed currently to buy this car. So essentially, they would buy this car on credit, and they would obtain the car first and then slowly pay back the money owed. So this is essentially a form of loan, however, on a much larger scale. So as previously mentioned, different people have different interest rates when we're taking a loan. However, how is this interest rate determined? And this is where credit scores comes in. So credit score is basically like a score that banks use to determine how credible or how likely somebody is to return this payment on time. So like, for example, if you're loaning a friend a video game, how likely are they to be able to return it back to you? Because if this person always loses the video game and never really returns it, you have already borrowed them, given them 3 games to borrow, and they never give them back, you're much less likely to want to give them this new video game, right? So essentially, banks use these credit scores to determine how likely the person is to return the money lent to them. So credit scores in Canada, they are given by 2 main companies. First called Equifax, the second is called TransUnion, and they rate these scores based on a point system between 300 to 900, with 300 being very poor and 900 being excellent. So over here, I showed a graph that dictates the average scores of Canadians from 300 to 760 plus, and most people fall under the category of excellent, so 760 plus. So the main determining factors of this credit score is the amount of late payment. So it's like a late payment history. So essentially, if the bank, they hold a bunch of history of your payments, and if they see that your payments are frequently late, then you'd usually have a lower credit score. There's also different determining factors, like a use of available credit, length of credit history, number of inquiries, and types of credit. So these companies, Equifax and TransUnion, they take all these into account. They plug them into a formula. This formula is not disclosed, by the way, because it's given by these companies and they don't give them to the public, but it's generally based on these payment histories, and they determine a credit score for you. So most cases it would be very good, but if it's pretty low, in order to increase it, you would have to try to pay back some of the payments and try to avoid late payments. And by doing so, you would have a very good credit score. And with a high credit score, most banks would be able to lend you this money at very low interest rates, very attractive interest rates and offers. Important to note that, however, credit scores aren't the sole determining factor of interest rates. They may also look at your income levels, where you earn this income, etc. And this totally up to the bank. However, the main thing that they look at is this credit score. So hopefully this helped you guys better understand how interest rates worked and how banks determine your interest rates. I put some links down below to check out more information about these credit scores, and hopefully you guys enjoyed and learned something. Learn the rules, win the game.